How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about the Bank-Fintech partnership and basically how is that going right now? It's a little bit on the rocks at the minute. So what happened earlier this year is that there was a bankruptcy of a company called Synapse Financial Technologies, and they basically blew up. And Synapse had they operated under what was called the BaaS model, the banking as a service model, and they provided a lot of kind of back end services for I think a few hundred banks around the country. Perhaps the most notable bank that they got in trouble with was Evolve Bank and Trust, and it turned into a huge thing. So Synapse files for bankruptcy. Basically, there was $85 million missing, and a bunch of companies, and it also affected a lot of fintech apps such as like Chime. I think one was like Yoda, something like that, and a number of others. And I reported on that in past episodes, but since that has happened, there has been this heightened scrutiny on basically banks and their kind of fintech vendors, fintech partnerships, as you were. On a side note, I hate the word partnerships. I hate the word partnerships because to me, in a very real way, a partner is somebody that you are in business with. And they share in both the earnings and the liabilities, the risks of the business. Like, in other words, and again, the problem is when you sign, it's really a vendor relationship. You're hiring them to perform a service for you. They're not a partner. They're not putting equity into your business. They're not sharing in your profits. And if things blow up and go bad, they're certainly not absorbing the downside risk. So it's just a pet peeve of mine. Like, I hate that partnership because it's not a partnership. It's a vendor. It's a service relationship. It's a vendor relationship. And that's why banks have third-party vendor management practices, because you're not managing partners, you're managing vendors that provide services for the bank. But anyway, that's a whole diatribe. But anyway, so the fintechs that banks do business with, the regulators are really come down strong, are really kind of hammering on how is the bank managing those relationships? How is the bank managing those vendors? What are you doing and how are you doing it? And it's kind of this very weird thing, because on the one hand, regulators want banks to be more innovative today. They want banks to offer new technologies and new products to their customers, and customers want that as well. So on the one hand, the banks, the regulators want banks to be more inventive, and they want them to, certainly take advantage of things like cybersecurity, using the cloud for better backup and, security protection, all that kind of stuff, disaster recovery, so on and so forth. So, on the one hand, you have the regulators really pushing this, but then on the other hand, you have the regulators really kind of beating banks up right now, saying, well, wait a minute, yeah, we want you to have this fintech, but we also, you have to manage this process, and you have to completely understand, who you're doing business with and what's going on there. And so it really gets to be this kind of Dr. Jekyll and Hyde kind of dichotomy there between, what's happening there. So anyway, I found these 3 articles basically detailing, like, okay, well, what's going on with the vendor relationship right now? Basically, how can banks better manage that relationship? And what do you want to do if you want to get out of that relationship? So let's take a look. So the first article that we're going to look at is called Digital Transformation Challenge for Smaller Banks, Getting the Fintech Partnership Right. And then we're going to look at a cautionary tale for bank fintech partnerships. And then we're going to wrap it up with dismantling problematic partnerships. How do you get out of these things, like once you're into them? So digital transformation challenge for smaller banks, getting fintech partnerships right. So fintech partnerships can be profitable for banks, but only when entered into cautiously and in compliance with regulatory standards. So an interagency group of regulators earlier this year issued a joint statement to address banks partnering with fintechs. The industry is becoming more digitally focused, despite concerns that an increased scrutiny may make some banks fearful of working with financial technology companies. Recent data shows that the number of Americans using online banking tools jumped from 53% in 2019 to over 66% in 2023. Meanwhile, the costs of developing the infrastructure to partake in this digital transformation remain high, disproportionately impacting smaller banks. So, despite increased regulatory oversight, building partnerships with fintech solutions can offer smaller banks a way to innovate and compete. Importantly, though, these partnerships must be built strategically with an eye on controlling risks. So, the first thing is kind of due diligence and ongoing monitoring. Um, for banks, it's important to build out strong risk management policies with due diligence being a priority. The regulator statement cautions that risk assessment can become more difficult as a bank fragments operations with third parties. Banks should work with potential partners to outline processes and protocols for review, including compliant and information security policies, business continuity plans, and service organization control reports. Due diligence should be an ongoing process built into the relationship with periodic follow-ups to ensure that the partner's protocols meet or exceed a bank's guidelines and that they are on top of every evolving regulatory landscape. Accurate record keeping, access, and reconciliation. So a bank, when a bank is not the system of record for deposits, i.e., the Synapse failure, that's what they're getting at here. Deposits sourced through fintech partnerships, the regulators highlight that it is imperative for that bank to understand record keeping functions, including who is responsible, who is performing reconciliation, and how customer funds would be returned in a worst case scenario, i.e., when Synapse blew up, where is the money and how are people getting it back? Strong risk management policies. One of the major concerns noted in the joint statement was that a lack of third-party oversight could impact the bank's compliance with consumer protection laws and regulations. So having partners that can live up to the benchmarks established by these protections can help reduce that risk. Understanding what the fintech can offer, because many smaller banks face unique challenges, including disproportionately higher compliance and cybersecurity costs, financial technologies can bring a lot of benefits without added overhead. Thanks to fintech, it's now easier than ever for smaller banks to compete. So the benefits can go beyond smaller banks assessing innovation and efficiency without associated overhead. For consumers using these fintech platforms, there is an unparalleled level of safety and peace of mind that regulated institutions can offer. Yes, that is true. But it also gets very tricky. I mean, again, you go back to the whole Synapse failure and you ask yourself, okay, $85 million went missing. Some people had, $1,000, $2,000, $3,000 sitting in their account and it just went poof, or they thought, they had an account with Bank A, when in actuality it was Synapse that was holding those deposits. So then they go to check one day and their deposits are gone, and they're like, well, wait a minute, what happened here? Well, well, the bank wasn't actually holding those deposits, even though your account was with the bank. Those deposits were actually being held by Synapse, the fintech provider. So again, you have to understand all these dynamics here. Due diligence, ongoing monitoring. Making sure that you're checking in with your fintech vendors every year. Are they keeping up with regulations? Are they keeping up with all this stuff? So again, very important to do all these things. So now let's go into, here's a cautionary tale for banks, fintech partnerships. Banks should not underestimate the importance of proper due diligence and compliance monitoring for all parties in BaaS models and fintech partnerships. And this talks all about Synapse. So the recent bankruptcy of Synapse Financial Technologies and the resulting negative impact on Synapse Bank partners, fintech clients, and their end users should serve as a stark reminder of the importance of proper due diligence and compliance monitoring for all participants involved in banking as a service models and bank fintech partnerships. Synapse was a technology middleware provider that connected banks with non-banks wanting to offer banking services to their customers. Following its bankruptcy filing in April, Synapse's four partner banks alleged that they had been denied access to Synapse's dashboard system, which they relied on to facilitate transactions, resulting in the banks freezing end user accounts. So according to the status reports from the bankruptcy trustee overseeing Synapse's case, the company used multiple partner banks to serve as different functions for the same fintech partner. In certain instances, fintech end user deposits were deposited in an account in one bank, while the same fintech end users' withdrawals were processed from a different account at a different bank. The trustee noted that this model has made it difficult to reconcile transactions and ensure end users receive access to the correct amount of funds due to each end user, a position that has been echoed by several of Synapse's partner banks while reconciliation efforts remain ongoing. So basically, exercise due diligence, bolster risk management. Regulators are taking notice of the Synapse bankruptcy and resulting fallout, which could mean further scrutiny of fintech partnerships and banking as a service provider. So, and then it's important to understand there that, some players in the BaaS space are basically getting out, or some banks are getting out of that model. Some of the players there are getting out of it because they kind of see the writing on the wall that, oh, okay, regulators are really going to come down on us, make us do a whole lot of stuff, which is make us, basically going to add compliance costs and everything, may not make the model as profitable as it was. And, and it goes on from there. And then this basically says, what regulators say. So to mitigate risk, banks should closely adhere to the guidance issued by federal regulators regarding third-party relationship risk management. Notice they didn't say partners. They said third-party relationship risk management. Sorry, my pet peeve there. So for instance, the joint statement on banks' arrangements with third parties to deliver bank deposit products and services issued on July 25th addresses potential risks that may be elevated for banks with delivering deposit products and services through a third party. The publication describes what the federal agencies views as effective risk management practices that banks should consider adopting to manage the potential risks from third-party deposit products and service arrangements. Similarly, the interagency guidance on third-party relationships risk management issued by the federal agencies in June of 2023 states that it is the responsibility of each banking organization to analyze the risks associated with each third-party relationship and to calibrate its risk management processes commensurate with the banking organization's size, complexity, and risk profile, and with the nature of its third-party relationships. And then concludes with, banks should ensure that their compliance policies and procedures incorporate such methodologies. So Synapse, the failure of Synapse has become basically the boogeyman, if you will, in the industry as it relates to fintech partnerships. And then finally here, dismantling problematic partnerships. So when entering a new third-party partnership, banks should develop a plan to manage issues as they arise and the fallout if the partnership fails. So number one here, know your rights. Many contractual protections seem superfluous. Love that word. It's a great word, superfluous. Until you need them. When faced with a failing partnership, banks should revisit myriad key clauses and questions, which hopefully they adequately addressed in the initial agreement, such as rights to terminate, indemnification, insurance, and limitations of liability. Notice. How do you provide notice? Who are the decision makers at your counterparty? Effective of termination. How will customer information be protected? How will a transition to a new partner or vendor be completed? What actions need to be taken to complete either a transition or a wind down? Have a plan that is consistent with your bank's underlying contractual rights is key to quickly and efficiently ending or rehabilitating your relationship. Number two, anticipate the end. Too often, banks fail to continue evaluating counterparties after executing an agreement. Diligence should not end at deal signing. Your bank needs to communicate with partners and vendors over the course of the relationship so it knows when problems arise. An annual partner review is often too late. Three, prepare to pivot. Knowing your contractual rights and appreciating your partner's situation will allow you to take the next steps that will help your institution ensure continuity and the ability to continue serving customers. Document everything. An old litigation partner of ours used to chide clients with the phrase, if you can't prove it, it didn't happen. And then number five, do not fear disputes or dispute resolution. Litigation is not always the right option, but it should be an option that banks at least consider when a partnership dissolves. Depending on your partner's financial wherewithal, the strength of your claims, and other factors, the non-combative route can sometimes cost your bank thousands or even millions of dollars of a potential recovery. There may be even greater incentive for banks to pursue an adversarial action if their agreement contains a prevailing party or other fee shifting mechanism. Um, and then it concludes here, I believe this, yes, concludes here by saying a messy divorce can mar even the most dynamic of duos or groups. By heeding these lessons, you may not be able to avoid trouble, but these lessons may help you to manage partnership issues when they arise and the fallout when the partnership fails. So, again, just to recap that. So, know your rights, anticipate the end. Number 3, prepare to pivot. Number 4, document everything. And number 5, do not fear disputes or dispute resolution. So I think following that platform, I think that, again, I think this was a great article, in terms of, how do you get out of these contracts? And these contracts can be very, very sticky, and it can be very expensive to get out of these contracts. Usually these contracts come with, they could be 5 years, 10 years in length. And like I said, and they have termination clauses and, penalties, like, for getting out of the contract. So it can be very costly and very expensive for a bank to terminate these agreements and get out of them. But I think these are great recommendations here. And if you follow these, I think your odds of getting out of them and minimizing your cost in doing so go up substantially. And getting out of it without it turning into an utter train wreck, is the key. I think that's the key. Can you get out of it without this thing turning into a massive train wreck? And, and again, look, I mean, sometimes these things can just be very difficult to foresee. You just don't, nobody has a crystal ball. Nobody knows exactly when these things are going to happen. I don't think anybody would have anticipated Synapse blowing up the way that they did, but it happened, and now we're kind of left with the fallout and the consequences of that going on. So again, I thought this was a really interesting episode on just managing the vendor relationships, managing third party relationships. What banks need to do now that we're getting this increased regulatory scrutiny. We have to continue to innovate in the industry. We have to continue to work with these fintech providers, fintech partners, however you want to describe it. And that has to continue to work. So we have to balance the regulation, the monitoring, the due diligence with the cost of everything. And, so we have to continue to find that balance within the industry, because we can't stop this stuff. I mean, this stuff we can't get the regulatory burden and the monitoring, the oversight. It can't get so onerous that basically that this stuff just doesn't work anymore, or it becomes so cost prohibitive that just nobody wants to do it. So okay. That's my episode for today. If you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love to get back to everybody. And please check out some of the other content on the channel. If you have not checked out the weekly live stream, BND Strategy Room, it is every Friday night at 7 p.m. live on YouTube. So please check that out when you get a chance. And I will be back to everybody again real soon. Thanks a lot.